find out what your lender is willing to do or willing to take, and also shop around, make sure that the interest, it might be 3% and you might think that that's good, but you might get a better interest of 2.8 or 2.7. That 0.3 is a hell of a difference, trust me.
Hi guys, welcome back to Kay and Didi. It's your girl Kay
and your boy Didi.
Welcome. If you're new to the channel, make sure to subscribe and also leave us a comment. And if you're a returning subscriber, welcome back. Hope you guys are doing well. In today's video, we're going to be talking about interest only versus capital repayment mortgages. Now, before we get into the video, first of all, the reason why we want to talk about this is basically due to the current circumstances. It's very difficult to get a mortgage currently because of the high demand and also because of interest rates. There's so many issues, and also the cost of living going up, so it's extremely difficult. And I was scrolling on Facebook and I saw a comment from somebody they left on mortgage, let me just say a bank, and the basically said that they were refused a mortgage for them and their partner because they were not married, basically, but they had been together for 19 years. I know, right? That's surprising, right? So I wanted to talk about this topic because I want to see if there's a way, once, you know, if somebody's ready to purchase a property, what is the best mortgage to go for? Is it an interest-free or interest-only or capital repayment mortgage? Like, which one is the best option for them?
I was gonna say which interest-free mortgage is.
I know, right?
But to be honest, it really depends. And just touching on the comment that you saw about the people, maybe because they weren't married, so both their incomes couldn't be considered. So maybe individually they didn't have enough for the
I think
mortgage.
It's still strange because...
Hello. Wait, what is this video about?
Interest only versus capital repayment mortgages.
Oh, so what does that mean?
Well, that's what we're trying to explain.
Okay. Yes, so blah, 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 blah. Yeah.
So that's the mortgage advisor right there. Okay, so basically how it works in terms of the mortgage packages. So interest only is effectively, let's say you say I want to borrow maybe 100,000, right, on a mortgage,
right,
and they say the interest is 2%, right, or 2.8% or whatever, right? So interest only, you're only paying the interest on that, right. So you don't pay towards the property. Of course, you put your deposit down, etc. Right. So let's say your deposit is, let's just assume 10,000, right, 10%. So you take out the loan of 90,000. That's hanging over your head,
right?
But what you're paying back is the 2.8% every year on it. So if you take out a loan maybe of, let's just say you're obtaining it for 20 years, in that 20 years you're going to be paying back the interest, right? That's what that means. But eventually your mortgage lender can either say, well, how do you plan on actually paying back the 90,000? Right? We're happy that you're paying the interest because you're giving us money.
Right. Yeah.
But how do you intend on paying the 90,000 back? Because the mortgage company, you own the house, they have the mortgage out on you.
Yes.
But I'm guessing they probably don't have any intention of owning that house.
No.
Or taking it from you. They want their 90K plus the interest, right? So as a business, that's how they run. So this leaves a lot of mortgage companies or lenders not offering the interest only solution.
Yeah.
Because that's a higher risk.
On their side.
On their side, it's a higher risk because technically you are a high risk if you're saying I want the interest only. Unless you explain this is X, Y, and Z, and I'm going to go into some good reasons why you would get interest only. But let's just assume you want to live in it. So you're a higher risk and you're asking for interest only, which means that the way they see it is you doubt that you can pay back the capital and the interest. You know, you want a lower mortgage because you're maybe earning less money, or you don't feel you can afford it.
Yeah, you assume that you won't be able to afford.
Yes.
Yeah.
The whole thing. So what they say is, what you can do is then you can say, you know what, I'm gonna take 90K, right, interest only for from January to December, right? But come December or November or December, I'm gonna pay 3,000 towards it, right? So then you knock off 3,000 from the 90K.
Yeah.
So now you owe 87.
Yeah.
That's a way you can do it. You can play it for the interest only. Now, just to finish the point on the interest only before I go into the capital repayment, is if you want to, it's good for property investment.
Yeah.
Because if you want to say, okay, I want to buy this property and rent it out, okay, but I want to potentially maximize my profit at the end of it, I'm going to say I want an interest only mortgage. Still saying to the guys or the lender, I'm going to pay X amount towards it every year. But the beauty about it is, let's say your mortgage is $100 or £100, right? Let's say a month. But you're renting that property out for 400.
Yeah.
This is interest only, so you're only paying the interest of £100. Let's assume 90K.
So you're making more profit than
more
you're
profit.
paying for the mortgage. Whereas
much,
if
yeah.
you did the traditional way, you'd be paying
Maybe your mortgage will be 250.
Yeah.
So you only make
your profits
150.
are smaller.
Yeah.
So I guess in terms of, I think it's the best option for people who are looking to invest in properties because it makes sense.
Yeah.
Yeah.
And potentially if you want to live, because in today's climate, it's harder to get mortgages and stuff. So if you just want to get on that property ladder, which is advisable to do as soon as you can, then that's a good way you can go. But just know that one, there might be less products or packages available or less lenders available. And two, that interest might be higher because you might be seen as a risk.
Yeah.
So it might work out that you end up just paying the equivalent of capital and interest from a different lender. And three, it might be a burden that at the end of the year you have to cough up so much money, like to pay towards it, unless you're putting money every month aside, So now on the capital repayment and interest, is basically you're paying something towards the property, but what could potentially be bad about that is, or not bad, but
frustrating in a way.
Is that a lot of lenders, they have a hyperinflated interest. So they might say 3%, 4% kind of thing, right? So what ends up happening, especially at the start up to the first 6 years, you end up paying a lot more interest than you will be paying towards your property, So you might end up paying, let's say, if you pay 10K a year in terms of mortgage plus your interest, out of that 10K, maybe 4K goes towards, so you're paying 6K. So it all depends on basically your situation, what you want to get out of it, and basically what you can afford, really. But I would say if you can do the repayment and the interest. I'm not really saying that because I've never done the interest only route. It would make sense doing, because you still technically, either way you own the property, your name is on the deeds.
But I feel like it's also beneficial for you if you want to sell your property in a couple of years, because that means you've been putting money in a pot. And you get more money out of that property. Whereas if you're just paying interest, you're only paying the bank. You're basically not paying. So make sure, be careful. And I think that's what this video is actually really, really important. I didn't actually think of this at the beginning, but it's really important. You get advice from a lawyer so they can put you on the right mortgage repayment plan, because you don't want to be put on the wrong one. Say maybe you wanted the repayment one and then you later on find out you're only on the interest only payment plan, and you realize that actually nothing has been going towards your property, which would be
that's why a mortgage advisor is key, and a good mortgage advisor is key, and how you know a good mortgage advisor is if they basically tell you the different options and explain to you why that would be an option. Like for instance, my mortgage advisor, the last call we had, I wanted to remortgage, right, so I could get better rates. This is when the rates dropped. But he was telling me, well, it would be good, but you need to pay a fee to get out of it, right? And that fee to get out of it in the long run, I would not have been better off. I'll be paying less on my mortgage, but because I've already paid that fee it's an offset, so you
Yeah.
may as well do.
It's
So
a contract at the end of the day that
Exactly.
you've entered in, and I feel like both parties should continue with that, because
Hmm.
you wouldn't like it if, say, the bank came to you and says, "Oh, by the way, I'm gonna cancel your mortgage." Like, it wouldn't be good. So I feel
I
like it's
wouldn't
the same-
mind because the house I get the house for free.
Well, yeah, of course, but you get what I mean. So
Yeah.
I think of it like a contract on the phone or your internet.
Yeah.
You know, you can't just get out of it. It's not as easy
Yeah.
as today, I don't want to be with this mortgage company. You have to wait out and finish up your contract. When your contract finishes, then you can move on to the next one. I think that's why it's highly important if you're purchasing your first property, your first mortgage, make sure you get a short.
The fixed rate.
Yeah, the fixed rate should be just, I would say, for a short period of time.
About
Just
2
so
years.
you can have the option to change
Yeah.
if you don't like it, if something else comes up that's better on the market. Because if you have it longer, you'll be stuck paying so much money
Yeah.
at a very high rate. So for me, definitely do it like the way you do electricity, right? You go on Money Supermarket and every single year try and browse and see the options that you can get. You can possibly get it cheaper, or the way you do your car
Exactly.
insurance. It's just basically the same thing.
Yeah.
So yeah, I think
Exactly. I mean, there was a time a few years back where the interest was 1%.
right.
That's where you get 10-year interest, fixed interest.
Yeah,
You know,
exactly.
because
it makes sense.
yeah, you're not gonna. Whereas when I was getting it, I was like, okay, 3%, because everything was just so crazy.
Yeah.
You know, and I was like, no, 3 years, and I was like, everything's so crazy. I've got a decent rate. I can afford it quite comfortably. I'm like, okay, cool, get that. And then after that, like COVID, we started getting let back out the cage, and we started going, oh, you know, so the interest rate started coming down
Yeah.
a bit, and I was like, rah, I need to get a better interest. It was only 0.5, but that 0.5 makes a difference when you've got like
Yeah.
so much
Exactly.
term of mortgage. Yeah,
Exactly. It makes a big difference. And I feel like now we're again in that situation, like, you know, for example, we were looking at, you know, I know this is off topic, but we're looking to purchase a property, not our investment property, but a family
another
home.
house, yeah.
And we were ready, like we didn't care because the property was so nice. Sadly, we lost out on the bid, like our bid. Yeah, anyway, let's not go into that because it's so sad.
It's emotional.
It's so sad. But yeah, so when we were looking, like the rates are so high again, like
Yeah.
when we were trying to get when he was trying to get a mortgage in principle for the family home, and then I have a mortgage in principle for another property that we're looking to purchase, but even at that, the rates that they were offering me are very questionable. So it kind of took me, you know, by surprise, because I thought, again, like you were saying, the interest rate dropped.
Yeah.
But it just shows you that it's going back up
Yeah,
again.
it fluctuates a lot, and I think what basically is part of the reason for that is because everyone is still not high off, like that COVID brought about that there was a huge property rush. Like people started buying properties, getting mortgages, like up to the yin yang, you know. And this, of course, created a lot of demand. So we're still towards that like hump side of it. So
Right.
it was going up. Usually the way it goes is in cycles. So it goes up, then comes down, and it goes up, right? But we're still around the top part
Yeah.
because people are still having that fear that properties are going to run out. Because there's a lot of builders that are building like there's no tomorrow.
Yeah.
You know?
Yeah.
Just to fulfill those demands,
Yeah.
because there's a lot of, you put a property on the market today, tomorrow it's gone. And people are bidding easily 20 to 25% over
Which is
the home report value.
shocking,
Yeah.
and I feel like that's how we lost out on our dream home, let me call it, because it genuinely was a dream home. It was stunning. It was literally
location,
and the
isn't it?
everything. It was really, really sad. Like, yeah, it pissed me off, and I wasn't happy. I'm not gonna lie.
We drive by the
But
house
congratulations
with
to whoever bought that house, because it belonged to me. But you know, right now we've taken a step back and we've kind of stopped because we've been checking the market to see what's available, but we just can't see anything as well.
Well,
That's another thing.
it's all about getting value for money, and that's the thing, that property prices are just crazy now that
Yeah.
you literally a lot of the times you're not getting your money's worth.
Yeah.
You know, you get a house that's just so basic, but there'll be the same price as something that would be classed as a mansion in the UK.
Yeah.
Which was like the house we were looking at. It was a mansion basically,
Yeah.
but the price was amazing. You know, so something like that around that same price, you're not really gonna. You could basically not get much for your money. So, and that's the thing people are maybe not really thinking about with the properties, because though it's good for if you're selling, but if
Yeah.
you're buying, it's not very good, because you think about you're paying way over the market value, and on top of that, you're paying stamp duty.
Yeah,
tax.
that's another thing.
You're paying tax. You know.
Tax on tax. That'll be the next video.
Exactly,
That's
tax
the
on
next
tax.
video. That's the next video we're gonna talk about. Tax
So
on tax.
you're paying all that stuff, right? And then on top of that, when you get to the house, you're not gonna be too happy about it,
No.
because maybe there's a lot of work that needs to be done, but because you were emotional about it and you rushed it or whatever,
Yeah.
you know. So I mean, yeah, but that's one of the things that need to consider when getting properties. And also back to the topic on mortgages, you know, figure out what your situation is, how much you can afford and stuff, and kind of be realistic and see which route you want to take. I mean, you can live in a property, I believe, with interest only, you know, but find out what your lender is willing to do
Yeah.
or willing to take, and also shop around, make sure that the interest, it might be 3% and you might think that that's good, but you
Yeah.
might get a better interest of 2.8
Yeah.
or 2.7. That 0.3 is a hell of a difference, trust me.
Yeah.
So
Not sponsored as well or anything, but you can go on comparison sites like Money Supermarket. Go compare
the market.
compare the
and
market.
They're
and-
probably all even the same.
Yeah. We're just comparing.
Yeah.
Just go on and compare, okay?
Yeah.
That's it. And I think that's so important. But that brings us to the end of the video. It's quite a long video, but hopefully what we've talked about is sort of helpful to you guys. Again, if you enjoy this kind of content, make sure you subscribe, and we'll be coming up with, we've got so many
Yeah.
topics to go through that are going to be so helpful to you guys if you're looking to invest in properties, whether it's for personal investments or whatever, or you just want to invest in like the general market. Like, no, I don't mean like Asda, like going to Asda and buying, but I mean the
Why
stock
not?
market.
You could go buy some, well, not Tesco because you're already paying too much, but you could go somewhere, Lidl, buy some cheap, then go and resell it somewhere.
Yeah.
You're still making money, innit?
Exactly. Right. That brings us to the end of the video. I hope you guys enjoyed it as much as we did. It's
Yeah.
always nice talking to you guys. And we'll see you guys in our next one.
And talk to us in the comment section. Let us know
Yeah.
Wagwan, and then we'll let you know Wagwan.
Yeah. Right. See you guys. Bye.
Take it.